Let's make a plan to build a nice 100k dividend portfolio using Australian stocks and ETFs that will not only provide you some sweet passive income, but also some capital growth over the long term. So the key to this plan is that you will be investing consistently over time until you reach that 100k goal. It's easier to do this in stages, so $10,000 would be your first goal, and then you would build from there. During that 100k, it's best to reinvest the dividends so that you can grow your portfolio even faster. But really, the magic formula of building a 100k portfolio is consistency. That is you putting the money in a regular amount of time and a regular amount over time. Time itself, as over the long term portfolios tend to grow, and of course choosing the right stocks and funds to put into your portfolio. So the one thing that you have the most control over is how much money you're going to invest and how often you're going to invest. So to reach 100k based on an average market return of 9.3%, which is what the ASX 200 has historically returned on average, this isn't even including dividends, so it's likely that you'll get there a little bit faster if you reinvest dividends. But if you can invest $500 a month, then it's going to take you a little less than 10 years to reach 100k. If you can invest $1,000 a month, then it'll be 6 to 7 years. And if you can invest $1,500 a month, that's only going to take you around 5 years to reach that 100k portfolio. But don't focus too much on how long it's going to take you to reach that 100k portfolio or whatever goal you've set for yourself. Just focus on how much you can invest and how often you'll be investing. Now, time is the one thing you have no control over because it's going to pass no matter what you do. What you can control is how you react to what happens to your portfolio during that time. I suggest a little patience, especially in the beginning when you're starting out, because it can feel like nothing's happening. Sometimes it can even feel like you're going backwards, especially if in the months following when you start investing that the market starts to dip and you start to wonder, why is it worth it all? But hang in there. It kind of comes down to luck when you first start investing, since no one really knows what's going to happen in the short term. But the longer that you invest, so as time progresses, you have a better idea of what the stock market's going to do based on past performance. And over the long term, we know that historically it usually goes up. Choosing what to invest in is a step that most people feel unsure about or nervous about. There's a perception that if you choose the wrong company that you're going to lose everything, but that's rarely the case. I'm not saying that it never happens, but there are many strategies that you can do to lower your risk investing in the stock market. The first thing you can do to lower your risk is to choose companies that have been around a long time, that have an established long-term record. The second thing you can do is diversify your portfolio. So that's not putting all of your money into one company, that's spreading it across a number of different companies and a number of different sectors. And of course, spreading your allocation of money over different funds or different companies so that you don't have the bulk of your money into one company and just small amounts in other companies. You sort of spread out your allocation over all of your investments. A lot of investors like to start with an exchange traded fund or an index fund, and I think that's an excellent place to start. If you start with an index fund or an exchange traded fund, you're going to get instant diversification right off the bat because you're investing in the top 200, the top 500 companies, whatever that fund holds. My favorite dividend ETF in Australia is Vanguard's VHY, but there are many other good ones as well. Now, whether you want to invest in funds only or also invest in individual companies is a personal choice. I particularly like individual companies because I can curate my portfolio better to the companies that I like, but it's also a good idea to have some funds in your portfolio as well. So make a decision whether you're going to invest in just funds, just exchange traded funds or index funds, or you're going to include some individual companies as well. If you are going to choose individual companies, this is what to look for. I always choose companies that have a dividend yield of 5% or more because I want a good return on my money. I also want to make sure that that dividend is stable so I can consistently guarantee that I'm going to get that income coming in, and I want it to be growing over time too. Usually it doesn't grow from dividend to dividend, but over the years it should be growing. Other things I look for is low debt in a company, and of course that the stock price is growing over time so I get some of that capital gains as well. Now, with individual companies, you do have to be mindful of having a diversified portfolio. I suggest holding at least 10 different companies and having a mix of different sectors as well. Now, you don't need to spend a lot of time doing this. It really isn't that time consuming. Do your research once and put all of the companies that you found that you like into a watch list. With most trading funds, you can set up watch lists, or you can just set up your own in a spreadsheet. It doesn't matter, just so you can keep a track of those companies and what they do in the future. And when you're ready to buy, you can choose one of those companies from your list. I actually have a number of different watch lists for different companies for different criteria as I'm watching it over time, so I can decide when I'm ready to buy which company I want to buy at that particular time. I do suggest sticking to the top 200 companies. You can probably go to the top 500 companies depending on the country that you live in, but in Australia I suggest sticking with the top 200 companies, mostly because they're already pretty established and you have a lot of financial information and a lot of track records and history that you can go and look at. I've talked about my process before and I've shown you how I narrow down the field of companies that I'm interested in. So if you want to see a step-by-step instruction on how to research different companies, just go and check out one of my other videos. And once you have your list, you have a number of companies that you want to buy. You can add to that over time, or you can delete companies if they no longer meet your criteria. But it's good just to have a list so that you don't have to do research all the time every time you want to buy. If you're buying over the long term, eventually when you start to buy different companies, you're going to have a good, well-rounded portfolio. Okay, so now you need to actually start. So I suggest starting with an exchange traded fund to start for everyone, no matter if you're going to invest in individual stocks as well or just funds. Be aware that some exchange traded funds don't have dividend reinvestment plans, so it's okay if they don't. What you can do then is when you receive the dividends, just put it in your savings account, and then when you're ready to buy, you can use that money to buy more of the company that you're interested in or the fund that you're interested in. Now, your first step, like I said, is to get to $10,000. I suggest just building up that fund to $10,000. That should be your first goal. Choose a good either index fund or dividend fund and just keep building that up to $10,000. Now, depending on what the stock market is doing at the time and how much you can invest, it's probably going to take you between 1 and 5 years to get to that first goal. Mostly because you'll be using your own money in the beginning because the market hasn't had time to start to grow and you wouldn't have received that many dividends. Once you hit that first $10,000, you'll actually find it easier going forward. You can decide whether you want to stick to just exchange traded funds or index funds, or now you can decide whether you want to start investing in individual companies as well. Do remember though that once you have some money in the stock market, it is going to start to grow over time, over the long term, and you will be receiving dividends during that time. If you're reinvesting the dividends, that means your portfolio is growing as well without you having to pay any trading fees. Now, if you're sticking with exchange traded funds, just keep building up that one that you're interested in, or you can get a second one. You probably don't need more than 2 exchange traded funds. 1 to 2 is fine. But if you're going to invest in single stocks now, you can start to think about which one is going to be the first one that you buy. I suggest that every time you save up $1,000 to $2,000, pick one of the companies on your list and purchase that. Do that until you have 9 to 10 companies within your portfolio, because your first goal before you start to build it is to get that diversification. So you want to get the amount of companies first, then you can start to build them up in amount of dollars that you're invested within that company. This just makes it less riskier for you because you want to get to diversification first before you start to build your portfolio to that 100K. But once you get your 9 to 10 companies and your exchange traded fund, you've got a diversified portfolio. So now you can start building them all up equally. When I say equally, I don't mean exact though. You don't need to be putting the exact amount of money into each company so that each company has exactly 10,000. Some companies in your portfolio are going to do better than others, and you want to put a little bit more money into those than the ones that aren't doing quite as well. Usually when I'm determining which company I'm going to build up, I might build, say, 3 or 4 companies at a time. And the companies that I'm choosing to build up are usually based on like what the dividends are doing, how stable the company is, has it been growing, basically all the general things I look for in the beginning if the company is still doing those things. I am always mindful of getting a balance though. Even though I may have more money in some companies than others, I do try to keep it pretty close just so I can get a reasonable balance and spread in my portfolio. So pretty much from $10,000 to 100K, you're in the building phase of your portfolio. First $10,000 is really just starting to your portfolio and learning to becoming an investor. But after the $10,000, so 10K to 100K is the building phase. So after you hit 10K, you will find that the market starts to help you along the way and it starts to kind of snowball. So compounding interest at its finest. I find that it really starts to snowball after about 5 years. And once you hit 6, 7, 8 years, it actually becomes a lot easier because the dividends are growing and being reinvested back into your portfolio. You're getting capital gains on your portfolio and you've invested your own money over that time as well. The slowest growth is always going to be the first 1 to 3 years. That's normal. So have a little patience. But like I said, it's going to start getting faster and easier after about 6 years. So if you start building your 100K portfolio now in 2022, depending on what the market does over the next few years, because we don't know short term what is likely to happen, you could reach that portfolio within 5 or 10 years. So it really matters what you do now as to what's going to be achievable in 5 to 10 years. And once you hit 100K, it goes even faster. I love compound interest and dividends so much. And of course, once you hit 100K, you can decide whether you want to start taking the dividends as income then, as you would have built up enough to have a nice little income on the side, or you can continue to reinvest those dividends to grow it even faster until one day you hopefully will be able to live off the dividends of your portfolio. It's such great passive income. Anyway, happy investing. I hope you've enjoyed this video, and I'll see you in the next one. Bye.